I want you to pause for a moment and really sit with the gravity of what is unfolding right now. Because this is not just another energy deal between trading partners, not just another diplomatic agreement that will be forgotten in the next news cycle, and certainly not just another round of economic negotiations between allies. What we are watching is the systematic dismantling of leverage that the United States has relied upon for decades, replaced by a coordination between Canada and Europe that makes American approval optional in the future of transatlantic energy security. I have spent decades watching power from the inside, arguing constitutional cases, observing how political decisions create cascades that most miss until the damage is irreversible. And I am telling you right now, the $380 billion energy infrastructure deal signed between Canada and the European Union represents not just a commercial transaction, but a fundamental recalibration of who controls energy flows, who sets the terms, and what that means for American influence in the Atlantic Alliance. So let me ask you three questions. When Canada commits to delivering 15 billion cubic meters of liquefied natural gas annually to Europe through new terminals that bypass American export facilities entirely, what does that do to Washington's ability to use energy access as diplomatic leverage? When European nations invest $127 billion in Canadian pipeline infrastructure, port facilities, and LNG terminals, creating permanent supply chains that don't require American participation, what happens to the assumption that Europe needs American energy coordination? And when Prime Minister Trudeau and European Commission President Ursula von der Leyen announced this partnership 48 hours after Trump threatened 25% tariffs on Canadian goods, what message does that send about who has alternatives and who is isolated? Systems don't collapse overnight. They erode slowly through moments like this. These are not theoretical questions. These are being answered right now in real time. For more than 70 years, the United States and Canada built an integrated energy relationship that worked because both countries understood the economic logic. Canadian energy resources flowed south to American refineries and markets. American capital funded Canadian extraction and transportation infrastructure. The system functioned with boring predictability, not because of ideology or sentimentality, but because it made economic sense for both nations. Canada got access to the world's largest energy market right next door. The United States got secure, stable supply from a democratic ally with vast reserves. It was so reliable that energy planners on both sides of the border made trillion-dollar infrastructure investments based on the assumption that this integration would continue indefinitely. The pipeline networks, the refineries configured for Canadian crude, the electrical grids synchronized across the border, all of it reflected decades of cooperation built on mutual benefit and trust. And critically, this integration gave the United States leverage. When European nations needed alternatives to Russian energy, they looked to Washington. When global energy prices spiked, American coordination with Canada allowed the U.S. to position itself as the reliable supplier. The assumption embedded in American foreign policy was straightforward. North American energy was effectively a single system with the United States as the indispensable coordinator, the nation that controlled access, set terms, and could use that position to advance broader strategic objectives. That assumption of predictability, that boring reliability that enabled massive long-term investments and gave Washington geopolitical leverage, has been systematically dismantled over the past 3 years. And what replaced it was not a better partnership. It was a calculated Canadian strategy to reduce dependence on American markets and American approval entirely. What triggered this moment wasn't a misunderstanding about energy markets or a technical disagreement about pipeline routes. It was a deliberate escalation that made it impossible for Canada to continue treating the United States as a reliable partner. Not temporary trade friction that could be negotiated, not regulatory differences that could be managed through diplomacy. A comprehensive approach that combined threats of 25% tariffs on all Canadian goods, public statements about potentially annexing Canadian territory, demands that Canada redirect energy exports away from global markets to serve American interests exclusively, and the revival of Keystone XL pipeline proposals framed not as mutual benefit, but as American entitlement to Canadian resources. The breaking point came when the administration suggested that Canada should accept limits on its energy exports to Europe, unless those exports were coordinated through American LNG terminals, essentially demanding that Canada pay the United States for permission to sell Canadian energy to European customers. It wasn't framed as a partnership proposal. It was framed as an ultimatum. Accept American control over your energy export strategy, or face economic retaliation that will cripple your economy. That demand crossed a sovereignty red line that no G7 democracy could accept. Canada's calculation process was remarkably straightforward. Option 1, accept American dictation of Canadian energy policy, sacrifice economic sovereignty, and remain perpetually vulnerable to political volatility in Washington. Option 2, use the crisis created by the Ukraine war and European desperation for Russian energy alternatives to forge a direct partnership with the EU, invest $380 billion in infrastructure that permanently diversifies away from U.S. dependence, and build leverage that makes future American threats hollow. And that is the line Canada refused to cross. Within hours of the deal's announcement, the effects began cascading through the system in ways that caught the administration completely off guard. The energy infrastructure sector felt it first. TC Energy, which had spent 15 years fighting for Keystone XL approval, announced it was redirecting $14 billion in planned pipeline investments from routes serving U.S. Gulf Coast refineries to new corridors serving Canadian Atlantic export terminals. That shift alone represented 8,900 construction jobs that Montana, Nebraska, and Texas had been counting on. When a factory stops, there's no narrative that fixes it. Enbridge, North America's largest pipeline operator, followed within a week. Their $9.7 billion expansion plan, originally designed to increase Canadian crude flow to Midwestern refineries, was revised to prioritize LNG liquefaction facilities in New Brunswick and Nova Scotia. The investment wouldn't disappear, it would just serve European customers rather than American ones. Pembina Pipeline announced a $6.3 billion joint venture with European energy companies to build storage and export infrastructure on Canada's east coast, explicitly stating in their investor materials that diversification away from U.S. market dependence is now a strategic imperative. The corporate realignment extended far beyond pipeline companies. Siemens Energy, the German industrial giant, committed $11 billion to building LNG liquefaction trains in Atlantic Canada. Total Energies, the French energy major, announced a $8.4 billion partnership to develop Canadian offshore natural gas fields that had been considered uneconomical when the only market option was the saturated North American system. Shell redirected a $7.2 billion investment from a Louisiana LNG expansion to a competing facility in Nova Scotia. These weren't abstract financial shifts. Each project represented thousands of engineering jobs, construction contracts, and long-term operational employment that American workers had expected to compete for. The European capital flooding into Canadian energy infrastructure created a self-reinforcing dynamic. As more investment committed to Canadian Atlantic export capacity, the economic logic of routing energy through American facilities weakened further. Export terminal capacity that had been designed assuming Canadian supply was now facing the prospect of permanent underutilization. And here's where the administration's fundamental misunderstanding becomes clear. They treated energy security as if it were a favor the United States did for allies, something that gave Washington leverage because alternatives didn't exist. But alternatives always exist when you create the political and economic conditions that make building those alternatives rational. Canada and Europe didn't discover new physics or invent new technologies. They simply decided that the cost of building direct energy infrastructure was lower than the cost of remaining dependent on an unreliable American political system. That calculation, once made, doesn't reverse itself just because Washington changes its tone. As the disruption spread, something unusual started happening that should have set off alarm bells throughout the administration. The American Petroleum Institute, representing an industry that employs 10.3 million workers, issued an emergency statement warning that Canadian supply diversification poses an existential threat to U.S. refinery utilization rates and energy sector employment. The U.S. Chamber of Commerce convened an extraordinary meeting of energy executives and released findings projecting that the Canada-EU deal would reduce U.S. GDP by $89 billion over the next decade through lost refinery revenues, displaced construction projects, and reduced energy trading volumes. These weren't environmental advocacy groups opposing fossil fuels. These weren't political opponents exaggerating economic costs. These were the core institutions of the American energy industry warning that the foundation of U.S. energy dominance was cracking. Republican senators from energy-dependent states began frantically calling the White House, demanding explanation and reversal. Senator Steve Daines from Montana, watching as pipeline routes that would have employed thousands of constituents were redirected to Canadian export facilities, gave a press conference that barely concealed his fury. We are watching American energy jobs move to Canada because our own government has made us an unreliable partner. Senator John Hoeven from North Dakota, representing a state whose economy depends on Canadian crude flowing to American refineries, introduced emergency legislation to prohibit tariffs on Canadian energy, a remarkable rebuke from a Republican to a Republican administration. Senator Ted Cruz, typically aligned with confrontational approaches, quietly told energy executives in Houston that the Canada-EU deal is the predictable consequence of treating allies like adversaries, acknowledging that the leverage Washington thought it had was always more fragile than the political rhetoric suggested. But the corporate panic revealed something deeper than immediate economic pain. The institutional investors who allocate capital to energy infrastructure were making fundamental reassessments about the future geography of global energy flows. Goldman Sachs released an analysis concluding that the Canada-EU partnership represents a structural shift in transatlantic energy architecture that will persist regardless of U.S. political changes. When the world's most sophisticated energy market analysts tell their clients that American centrality in Atlantic energy security can no longer be assumed, that's not speculation. That's the market pricing in a new reality. And here's what they're beginning to understand. What makes this moment particularly dangerous is understanding how power actually works in the modern energy system. For decades, American energy influence rested on two pillars: production capacity and network control. The first gave the United States the ability to supply massive volumes through domestic production and coordinated North American integration. The second gave American companies and policymakers control over the infrastructure, the pipelines, the export terminals, the shipping routes, the financing mechanisms that moved energy from producers to consumers globally. When those two pillars reinforced each other, the system was extraordinarily effective. The United States could influence European energy security without controlling European territory. It could pressure adversaries by threatening their access to energy markets that American companies dominated. It could use energy policy as an extension of foreign policy because the physical infrastructure required American participation. What the current administration is doing systematically undermines the second pillar, while assuming the first pillar will maintain American leverage regardless. They're creating political volatility that makes long-term infrastructure partnerships with the U.S. untenable, while expecting that production capacity alone will keep allies dependent on American coordination. But once you understand this framework, everything makes sense. Canada and Europe looked at those two pillars and realized something profound. The second pillar can be replicated with sufficient investment, and once that replication happens, the first pillar becomes just one option among several rather than an irreplaceable necessity. They're not trying to destroy American energy production. They're trying to make American energy coordination optional rather than mandatory. Once trust is replaced with contingency planning, the old system never quite comes back. And here's the rewatchability hook that most analysis misses. The real story isn't that Canada is abandoning the American market. The real story is that Canada is demonstrating that American market access was always a convenience that came with political costs. And when those political costs exceed the economic benefits, the entire logic of integration collapses. For 70 years, Canadian energy policy assumed that proximity to the United States made American markets the natural and permanent destination for Canadian resources. That assumption died the moment Trump threatened 25% tariffs. What we're witnessing is not protectionism or economic nationalism from Canada. What we're witnessing is the rational economic response to a partner that has made reliability impossible. You can't force dependence. The supply chain rerouting is already happening in ways that will prove devastating. The LNG shipping contracts being signed between Canadian exporters and European utilities. The pipeline capacity being permanently redirected from south-north routes to east-west corridors. The refinery configurations in Germany and Poland being optimized for Canadian crude specifications rather than continuing to depend on globally sourced blends. Each of these represents not just current transactions, but future dependencies that will make European energy security independent of American approval for decades. This affects your energy prices if you live in the Midwest or Gulf Coast states, where refineries will run below capacity. This affects your job if you work in pipeline construction, LNG terminal operations, or energy trading. This affects your retirement savings if they're invested in American energy infrastructure companies that are losing their guaranteed supply sources. Diplomatic infrastructure isn't built for headlines. It's built for the boring reliability that enables $380 billion investment decisions over decades. And that infrastructure is being systematically demolished in favor of short-term political posturing that satisfies a domestic audience while destroying the international partnerships that made American energy dominance possible. And this is where it becomes impossible to find a clean exit from the trap that's been constructed. The administration has two options, both damaging. Option one, escalate. Impose the threatened 25% tariffs on Canadian goods, attempt to block Canadian energy exports through regulatory interference, double down on the America First approach and hope that market size alone forces Canadian and European capitulation. The consequences would be immediate and catastrophic. Canada would retaliate with tariffs on American goods. The integrated supply chains that serve automotive manufacturing, agriculture, and consumer products across the border would fragment. Every threat would accelerate exactly the diversification that the tariffs were supposed to prevent. European governments watching America weaponize trade against a democratic ally over energy would conclude that any dependence on American markets is a strategic vulnerability. The result would be the complete collapse of the integrated North American economy, job losses in the tens of thousands across border states, and the permanent confirmation that American partnership is too volatile to be reliable. History suggests that escalation in trade wars tends to spiral beyond initial intentions, particularly when the escalating party has less leverage than they assumed. Option two, retreat. Abandon the tariff threats, drop the demands for control over Canadian energy exports, and attempt to rebuild the partnership that's been shattered. The consequences here are different but equally damaging politically. The strongman persona that's been cultivated domestically can't survive an obvious capitulation to Canada. The base that's been told American dominance can be commanded into existence would see retreat as weakness and betrayal. And most devastatingly, the retreat wouldn't actually reverse the structural changes that have already occurred. The $380 billion has been committed. The infrastructure contracts have been signed. The European dependency on Canadian supply is being built into physical pipelines and LNG terminals that will operate for 40 years. The venture capital and institutional investment that's flowing into Canadian energy infrastructure isn't going to reverse course just because American political rhetoric softens. Companies that have been burned once by policy volatility build permanent hedges against future volatility. Reliability, once lost at this scale, requires decades to rebuild, not months. The administration is trapped between two equally damaging options: escalation that accelerates the economic decoupling and costs American jobs, or retreat that exposes the leverage as hollow and damages the political brand. History and political incentives suggest they will choose escalation, which means American workers in energy-dependent states will pay the price, while the architects of this strategic disaster remain insulated in their ideological certainty. But here's what makes this truly devastating. Canada hasn't just signed an energy deal with Europe. Canada has accomplished something extraordinary, not through confrontation, not through threats, not through any adversarial posture, but by making the United States unnecessary in the future of transatlantic energy security. They did it by being more reliable, more willing to make massive long-term investments without demanding political subordination, and more committed to partnerships based on mutual benefit rather than leverage and coercion. And in geopolitics, that's the most devastating outcome of all. Not to be defeated in confrontation, that can be spun as noble resistance against overwhelming odds, but to be rendered optional, to have allies simply build around you because working with you has become too unpredictable and too costly. That era is gone. The era where geographic proximity and market size alone guaranteed that Canadian energy would flow south and give Washington leverage over both Canadian policy and European energy security is over. The era where allies had no choice but to accept American terms because alternatives didn't exist is finished. The modern energy system doesn't reward size without stability. It doesn't reward market access without reliability. It rewards the countries and the partnerships that can provide the boring predictability that allows companies to invest $380 billion with confidence that the political environment won't destroy that investment on a whim. Canada and Europe understood that. They built their partnership around that. And it's working. And once pipelines get built, once LNG terminals come online, once shipping routes establish themselves, once European utilities sign 30-year supply contracts with Canadian producers, it does not reverse itself. Every energy company is drawing conclusions about where to invest in new extraction capacity. Every infrastructure developer is drawing conclusions about which export routes will have stable political support. Every European government is drawing conclusions about which partnerships provide energy security without political subordination. Every institutional investor is drawing conclusions about where energy dominance will reside in 2040, in 2050, in 2060. What we are witnessing is not a temporary realignment that will correct itself when political rhetoric changes in Washington. What we are witnessing is the beginning of a structural transformation in how energy moves across the Atlantic, who controls that movement, and what leverage that control provides. And the tragedy is that this was avoidable. The United States had every structural advantage: the existing infrastructure, the integrated markets, the established relationships, the geographic proximity. All of it favored continued American centrality in North American energy. All that was required was the basic recognition that in an era of global competition for energy security partnerships, you cannot treat your advantages as permanent entitlements that will persist regardless of how badly you manage them. You cannot threaten tariffs and expect partners to remain dependent on your markets. You cannot demand control over allied energy policy and expect those allies to accept subordination. You cannot treat a 70-year partnership built on mutual benefit as if it were a relationship of dominance and submission. The people paying the price are not the architects of this catastrophic strategic error. The people paying the price are the American workers who won't get those 8,900 pipeline construction jobs in Montana. The refinery workers in Texas whose facilities will run below capacity because Canadian crude is being redirected to European markets. The energy traders whose commissions evaporate as transaction volumes shift from American terminals to Canadian Atlantic ports. The American families in North Dakota and Wyoming whose local economies depend on energy sector employment that's being systematically undermined by political decisions made in Washington. Reliability is the true currency of power, and that currency has been systematically devalued in favor of short-term political theater that plays well domestically while destroying the international partnerships that made American energy influence possible. The question now is not whether this can be reversed. The question is how much more ground will be lost before someone in Washington understands that you cannot bully your way to energy dominance in an era where allies have the capital, the resources, and the political will to build alternatives that make American approval optional rather than essential.